Imagine you're standing in 1970. Gold is $35 an ounce. Most people think it's overpriced. The government says the economy is strong, the dollar is backed, the future is bright, and anyone worried about inflation is being called a fearmonger. Now fast forward just 10 years. Gold had climbed over $800. The people who ignored it lost. The people who listened, they changed their financial lives forever. Now, here's the question nobody's asking right now. What if silver is sitting in that exact same moment today? What if, right now, in 2025, silver is where gold was in 1970, quietly waiting, massively undervalued, and almost nobody is paying attention? Because here is what most people still don't understand. Silver is not just a shiny metal. It is not just jewelry or coins sitting in someone's drawer. Silver is one of the most industrially critical materials on the planet. It is inside your phone. It is inside the solar panel on your neighbor's roof. It is inside the electric vehicle sitting at the charging station. And right now, the world is consuming silver faster than it is being pulled out of the ground. Stay with me for the next 15 minutes. Because by the end of this video, you are going to see silver in a completely different way. And if you are the kind of person who wants to understand what is really happening in the global financial system before the mainstream catches on, then you're exactly where you need to be. Welcome to the Bullion Horizon. Subscribe plus like CT. Before we go any further, if this kind of real research-driven financial content is something you want more of, hit that subscribe button right now. We do not do noise here. We do not chase headlines. We do the work. And if this video is already making you think, go ahead and tap the like button. It genuinely helps us reach more people who need to hear this. Now let's get into it. Because this story goes much deeper than most people realize. The silver paradox. Let's start with something that should make every rational investor stop and think. Silver has been used as money for over 4,000 years. It was once so valuable that ancient empires built their entire economies around it. Spain extracted so much silver from South America in the 1500s that it literally changed the global price of money. The Roman Empire depended on silver. Medieval trade routes were built around it. For most of human history, silver was not just a commodity, it was civilization's foundation. And today? Today you can buy an ounce of silver for around $30. $30 for something that took billions of years to form underground, something that requires massive mining operations to extract, something that the world's most advanced industries cannot function without, something that is disappearing from above-ground stockpiles at a pace that would have seemed impossible just 20 years ago. Now pay attention to this part, because this is where the story starts to feel almost unbelievable. In the 1980s, there were approximately 10 billion ounces of above-ground silver stockpiled around the world. Government vaults, private hoards, industrial reserves, 10 billion ounces. By the early 2000s, that number had collapsed to somewhere around 1 billion. The world had consumed 9 billion ounces of silver in just 2 decades. Not because people were hoarding it, not because of financial panic, but because the world's factories needed it, and it was just gone. Used, melted, processed, and in most cases, too expensive to recycle. This is the part the mainstream media rarely explains properly. Silver is what economists call a consumed commodity. Unlike gold, which is almost entirely preserved and recycled, silver gets used up. It disappears into products, into electronics, into medical equipment, into batteries, into solar panels, and once it is gone, it is extremely difficult to get back. The solar revolution changes everything. Here is where the modern story of silver gets genuinely staggering, and this is where most investors are still sleeping. The global push toward renewable energy, specifically solar power, has created a demand for silver that the market was simply not prepared for. Every single solar panel produced in the world today contains silver. The average panel uses somewhere between 15 and 20 grams of silver. That might not sound like much. But when you start multiplying that across the hundreds of millions, and eventually billions, of panels being installed worldwide over the next decade, the math becomes almost impossible to ignore. In 2023 alone, the solar industry consumed somewhere around 200 million ounces of silver. That is roughly 20% of the entire global silver supply, just for solar. And demand from that sector alone is projected to potentially double or triple by the end of this decade. At the same time, total global silver supply has been essentially flat for years. Mines are not expanding fast enough. New discoveries are not keeping up with consumption. The pipeline is thin. And here is what makes this situation genuinely different from other commodity stories. You cannot replace silver and solar panels with something cheaper. Researchers have been trying for decades. Silver is simply the best electrical conductor available at industrial scale. It cannot be easily swapped out. The panels need it. The grid needs it. The green energy revolution, the one that governments around the world have staked their entire climate policy on, runs on silver. So think about what that actually means. Governments are mandating the transition to clean energy. Corporations are pledging net zero targets. Trillions of dollars are being deployed into solar infrastructure. And all of that demand is funneling directly into one metal that is already in short supply: the gold-silver ratio. Now let's talk about something called the gold-silver ratio. This is one of the most important and most ignored signals in the precious metals market. The gold-silver ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, going back thousands of years, that ratio averaged somewhere around 15 or 16 to 1. Ancient Rome fixed it by law. The early United States government fixed it at 15 to 1. The ratio held at those levels for most of recorded human history because people instinctively understood that silver and gold were both money, and the ratio between them reflected their relative rarity and value. Today, that ratio sits somewhere around 80 to 90 to 1. It has spiked above 100 in recent years, which means that by historical standards, silver is extraordinarily cheap relative to gold. If the ratio were to simply return to its long-term historical average, not some extreme prediction, not some conspiracy theory, just a return to the historical mean, the price of silver would need to increase by a factor of 5 or 6 relative to gold at current levels. We are talking about a price that would shock most people who are not paying attention right now. And this is where the story changes completely, because the ratio is not just a financial abstraction, it is reflecting a real imbalance, a real gap between where silver is priced and where the fundamentals say it should be. And markets have a way of correcting those gaps, sometimes slowly, sometimes violently. The institutional angle. But here's what most people still don't realize about silver. The institutions know, quietly behind the noise of the stock market and the drama of cryptocurrency and the talking heads on financial television, some of the world's most sophisticated investors have been accumulating silver and silver-related assets. Not in ways that generate headlines, not in ways that tip off the public, but in ways that show up if you know where to look. Silver ETF holdings have surged in certain periods. Mining company stocks have attracted unusual institutional interest at key moments. Certain central banks, particularly in Asia, have been very quietly increasing their exposure to precious metals broadly, and the number of hedge funds that have been building positions in commodities with tight supply-demand dynamics has been growing consistently. This is not about conspiracy. This is about pattern recognition. Smart money does not wait for the headline. Smart money positions itself before the headline arrives. And then when the public finally catches on, when silver starts making the news, when your coworker starts asking about it, when it starts appearing on the front page of financial websites, that is usually when the biggest move has already happened. The question is always the same. Will you be on the right side of that trade? Or will you be the one watching from the outside, wondering how you missed it again? The monetary system wildcard. Now, I want to bring in a dimension of this story that most silver discussions leave out, and it might be the most important one of all. The global monetary system is under serious structural pressure. The United States dollar has been the world's reserve currency since the end of World War II. That status gave America enormous power, the ability to borrow cheaply, to run deficits that other countries simply could not sustain, to export inflation around the world. But that privilege has come at a cost, and the cracks are starting to show. Global debt levels have reached numbers that would have seemed fictional 20 years ago. The United States national debt has crossed $34 trillion. Global debt as a total is well above $300 trillion. Interest payments on that debt are consuming larger and larger portions of government budgets. And the countries that hold the most dollar-denominated debt, particularly China, Russia, and a growing number of emerging market nations, are actively looking for alternatives. The BRICS nations have been openly discussing the possibility of a commodity-backed trade currency. Several countries have been settling oil trades in currencies other than the dollar. The de-dollarization trend is slow, uneven, and complicated, but it is real. And if we ever see a significant shift in how the world views the dollar's role, the flight toward hard assets would be historic. Silver is a hard asset. It always has been. It cannot be printed. It cannot be created by a central bank. And unlike gold, it is still affordable for ordinary people. A working-class family in Oklahoma can buy a few ounces of silver. They cannot buy an ounce of gold every month. Silver is the people's metal. And in a world where trust in paper currency is quietly eroding, that matters more than most people are willing to admit right now. The supply problem nobody is talking about. Let's talk about where silver actually comes from, because this part of the story is not getting nearly enough attention. Roughly 70 to 75% of all silver mined globally is produced as a byproduct. That means it comes out of mines that are primarily digging for copper, zinc, lead, or gold. The miners are not really in the business of silver. Silver just happens to come along for the ride, and that creates a structural problem that most investors completely overlook. If copper demand slows down, if the global economy hits a rough patch, if manufacturing contracts, copper mines slow down. And when copper mines slow down, silver output falls with it. Even if silver demand is screaming higher, even if solar installations are expanding, even if industry needs more and more of it, the supply side cannot respond independently. Because the supply side is not primarily driven by silver economics. It is driven by the economics of other metals. This is what commodity analysts call a supply inelasticity problem. The supply cannot respond quickly to price signals. Even if silver doubles in price tomorrow, new silver mines cannot be built overnight. The permitting alone can take a decade. The drilling, the environmental assessments, the infrastructure, it all takes time. Time that the industrial users of silver simply may not have. And here is the quiet alarm bell that almost nobody in mainstream finance is ringing. The Silver Institute, one of the most respected industry research bodies in the world, has documented several consecutive years of silver supply deficits. That means the world has been consuming more silver than it has been mining. The gap has been filled by drawing down existing stockpiles. But stockpiles are not infinite, and the trend is pointing in one direction. Well, what happens next? So where does all of this lead? Let's think through the realistic scenarios heading toward 2030. In the base case, solar deployment continues to grow. Electric vehicle adoption accelerates. Industrial demand for silver keeps climbing. Mining supply stays constrained. Stockpiles continue to draw down. And at some point, the price has to reflect that reality. The market cannot stay disconnected from the fundamentals forever. It never does. In a more aggressive scenario, we get a combination of factors converging simultaneously. Supply deficit deepens. Institutional money moves into silver. Retail investors wake up to the opportunity. A currency shock somewhere in the world accelerates the flight to hard assets. And the gold-silver ratio begins its long-awaited compression back toward historical norms. In that world, silver does not just go up. It goes up in a way that reshapes the wealth of anyone positioned ahead of time. And in the wildcard scenario, the one that people do not like to talk about because it sounds extreme, we get a genuine supply crisis, where industrial users are competing directly with investors for physical silver, where the futures market and the physical market diverge, where the price discovery mechanism breaks down and real silver commands a premium far above the paper price. It has happened before in smaller ways. In 1980, the Hunt brothers nearly cornered the silver market and sent prices to $50 an ounce in a matter of months. The market was eventually controlled through regulatory intervention. But the underlying principle held. When the physical supply gets tight enough, the price becomes almost unpredictable. Here's what I want you to sit with for a moment. We are living through one of the most complex and uncertain economic periods in modern history. The rules that govern the financial world for the past 70 years are being rewritten. The energy system is being restructured. The monetary system is being challenged. Trust in institutions is at generational lows. And in the middle of all of that uncertainty, there is this ancient metal that has survived empires, outlasted currencies, and powered every technological revolution of the last century. Silver does not care about politics. It does not care about which party is in power. It does not care about interest rate cycles or quarterly earnings reports. It is real. It is finite. And the world needs more of it every single day than it is producing. I'm not telling you to put everything into silver. That would be reckless, and that is not what we do here at the Bullion Horizon. What I am saying is this. The information is in front of you. The supply data is real. The industrial demand story is real. The monetary pressures are real. And the window to understand this before the mainstream does is still open. But windows close. Comment plus, share CTA. So here is what I want to know from you. Drop your answer in the comments right now. Do you believe silver is the most undervalued asset of this decade? Or do you think the digital age has changed the game permanently and silver's time has passed? There is no wrong answer, but the conversation matters. And I genuinely read every single comment on this channel. And if you know someone, a friend, a family member, a coworker, who is trying to figure out how to protect their wealth in a world that feels more uncertain every day, share this video with them, not because you want to convince them of anything, but because they deserve to have access to this information before the headlines make the decision for them. The financial world rewards those who pay attention early. Always has, always will. This is the Bullion Horizon, and we will see you in the next one.